Welcome to this week's edition of Trade the Trend, a weekly video discussing where the stock market is heading. I'm Jason McIntosh. It is Friday the 25th of February 2022, and as always, this is general commentary and doesn't take your personal situation into account. Alright, with that said, let's get to our first chart. Well, look, there's been a lot of developments going on in the market since last week's video. And so in a moment we're going to look at stocks, we're going to have a look at gold, and we'll also have a quick look at uranium. But let's start off with the S&P 500, because really the stock market has been, there's been a lot going on in the last few days. So when we spoke last week, we were just sitting here, and my thoughts at the time was that the market might have one more tilt higher, might test up here, up above these, just above this was a 61.8% fib retracement up here. I thought we may have one more test there or a touch above and then have a decline. But as it would have it, we didn't get that bounce, we just got the decline. And look, that's always a risk. It's always a risk when the market's in a vulnerable position, that the bounces are either muted or they don't happen at all. So the bounce I thought we were going to get, it was one bounce too much. We got the bounce here, and rather than a zigzag type bounce, the bounce petered out around here and then started to roll over. And the big development that we've had in the week, well, the big development from the way I analyse markets, is that we've got the moving averages. The 50 and 100 day moving averages have crossed and turned to the downside. So that's pretty significant. It's pretty significant when you get those moving averages turning. Now, what I wanted to do, I just want to go back and look at the last few times that we've had a cross in the moving averages. So they haven't crossed to the downside since March 2020. That was, of course, during the COVID crash. And just straight off the bat, I'm not suggesting that this is what we're looking at this time, but it's just the last time they crossed was at that period. And we go back a bit further, and the time prior to that was here back in November 2018, and that led to another couple of months of market weakness, and some quite significant falls, a month or so after the cross. That's sort of more the possibility that I'm concerned about now, rather than a crash, more of a correction to come. And if we go back a little bit further still, it's and you can see they don't cross that often. That's why I say it's potentially quite a significant event when they do cross. It's time before that was just in this period here. So they crossed for the first time here during this initial part of a market correction. We got the big rebound, like I'm always talking about, looking for rebounds after sharp declines, because it's quite common the way markets behave. And then we got another cross as the market went down for its second leg of the decline. So look, they're just a few instances of the 50 and 100 day moving averages crossing. So go back to where we are now, and look, that's where we are. We're only a few days after the cross, so we're going to see what happens over the next. Look, I think this is something which could play out over the next few weeks, probably the next few months, more to the point that this isn't something which I see working itself out over the next couple of weeks. I think we're currently into something which could last for potentially a few months. And as I've been saying, this, I just do not think this is a time to be buying the dip. It's different. It's different to when the market was here and people saying, "Oh, look, let's buy the dip." Market had then pulled back to its moving averages, and when the market pulls back to a moving average, that actually is quite a good risk return opportunity to buy the dip, because the trend is still upwards. You buy the dip, and then you can get the next advance higher. All through here, these are all buy the dip opportunities where the market, you've got a rising trend and the market pulls back to the moving average. This is different. This was potentially a buy the dip here, but this dip kept dipping and it broke lower. So that's where you use risk management. You close some positions, you shut down some risk. Now we're trading below the moving averages. It's just a much riskier time to be buying the dip, and there is definitely a vulnerability to the markets when they are below the moving averages. So that said, all that said about the risk of buying the dip here, I just want to go across to the 4-hourly chart just for a moment, just to get a little bit more detail on the most recent price action. And so just when we look at this, so here we were last week. We had this sharp fall. Market got to this point about 48 hours ago, and we had some. Well, I'll just use this area through here. I'm just going to just quickly. We had a bit of a support. You can get a clear support level in there. Picks up these lows here. Market broke this level, and then we got this sharp downdraft. Would have been a case of lots of stop losses being placed below these lows. Very logical and an obvious place to put a stop loss, and a natural place to put a stop loss. That's where you put stops below previous lows. And these were lows of significance. And it also, when you look at the daily chart, this band was a big support level we've been watching. And so lots of stop loss activity. So you've got the sharp move down. What's been interesting the last 24 hours is we've got the sharp move back up. So to me, that suggests that maybe we've had enough of a clean out of long positions in the market, for now at least, to have some sort of a near-term low in place. And from there, we've got the possibility of getting some sort of a rebound from this point. So it's look, this isn't the sort of dip I want to be buying to sort of play this rebound, because I'm looking at more of from the daily chart perspective about the potential for this market to go quite a bit lower, maybe over the weeks ahead. So I'm not looking to play a short-term bounce, but we could see some strength. It's possible we see some strength develop over the next next few days. And let's just go back to the daily chart and look what I think could happen. I'm just drawing what I think could happen. Like, say we do get a bit of a bounce, it could be a case of something like that could develop, and then from there it's possible the market loses its momentum, and then we do get another test lower in a month or 2 months' time. That's a sort of pattern I drew out last week, but I was thinking, last week it was up here. I was thinking that maybe we get the bounce and then we get the decline, but we got the decline first. So maybe it's a case of now we've got that decline. Maybe now we get some sort of a bounce and then another decline after that, and that would be your classic zigzag correction. But of course, there's so much scope for that to be wrong. There's so many ways, so many pathways the market could take from here. That's just to give an idea of what the sort of thing which could happen. I think the key here is it's not whether the market traces out that pattern or does something else. I think the key here is to really just be very careful with how you approach this market at the present point in time. So what I want to look at now, I'm going to go to a weekly chart. Let's just jump over to weekly. And what I'm going to do, I want to go back to the GFC low and just look at the last 12 or so years. And I'm going to put it onto a log scale. So you'll see the chart change shape a touch when I do that. What the log scale does, it just makes the price action at lower levels, it puts it into a scale which makes it more readable. So just jump off log for a sec. You see the price action back here gets quite squashed, a bit hard to see. It looks like all the action's happening up here, but percentage-wise, the moves back here were just as significant as the moves up here. So log charts are good for looking at charts when you're going back 10, 20, 30, even 30 or more years. The longer back you go, the more useful log charts are. So what I want to do here, I just want to look back at a few of the past corrections that we've seen over the last 12 years, give some idea of what what could happen this time around. So we'll start back here. So back here, and I'm only going to look at corrections which were like 15% or greater. So we're looking at 15 to say around 35% in depth to the correction. So here's a zigzag. We've got to move down, we're going to move up, and we're going to move down. And then we move along to here. Again, it's another zigzag. Got the high, had the sell-off, the bounce, the sell-off. Then we get something different the next time we have. These were both around 20% corrections. This one here is around 16. So this is more of a flat correction or a sideways type ranging correction. Got the move down, the move up, made a slight new low there. So it is a zigzag-ish correction in a way, but it is more flat because it hasn't come down like that. It's pulled up just below and then rallied. Then we've got here, you can see how typical these zigzag corrections are. Move down, move up, move down. That was in 2018. And then of course we've got the crash. So these are all the various types of corrections you can get. Zigzags, flat type corrections, flat or sideways corrections, and crashes. I don't think we're getting this one this time around. I think it could be more the zigzag variety, but it could well and truly turn into one of these as well. So just to map out how this could be. Look, we've already done what could be the bare minimum. You could say we already have a zigzag correction, and the bullish scenario would be that the market did base somewhere around here and then sort of make its way higher over the next, I don't know, it could be the next month or two. I don't think so. I don't think that's the case, because I look at the magnitude of the rally we've had from those COVID lows, and that's like, look, that's a big rally which has really gone pretty much unchecked to date. Big rallies need to be checked at some point. So like, that's, for me, that's just not enough. I think this market has to do more work over the next few months. So for me, it'd be more a case of that we've got the maybe the first leg down, maybe we get some sort of rebound, and maybe that leads to something else in the months ahead. If we put some Fibonacci's on, like if we were to correct this whole move and move back down into this region here, around that 3,600, 3,800 sort of mark, would be within the scope and realms of what we've seen in corrections. And just out of interest to just see like what percentage fall that is, like that's a 25% fall into the mid-range of the upper Fibonacci's. Very normal to see a market do that after a big advance over an 18-month period. And that's what, really, that's what all these moves, these corrections were all about. They corrected larger moves, and they did come back within that, let's say averaging around that 20-25% mark, which is around here. So we don't know, as I say, lots of scope to call these things the wrong way, but I think it's a live possibility which I think we need to be aware of when positioning our portfolios. So it's, look, just to be clear, I'm still long this market. I'm not a bear who's looking for the worst case scenario. I'm still long the market because I still have a lot of stocks which are in upward trends, and I'm going to stay with those stocks while the trends are in place and the stocks are above their moving averages. I've had stocks hitting their not their moving averages, I should say their trailing stops. My stocks staying above their trailing stops. I've had stocks hitting their trailing stops over the last couple of weeks, and I've been exiting them as that's happened, and some I've missed, and I've been able to unload them on the rebounds we've had in the market over the last couple of weeks, and that's why I'm playing it. So I don't think this is a case of selling all your stocks or cleaning out a portfolio completely and sitting on the sidelines. I think that's a dangerous approach, because there always is a possibility that this correction does wind up being not as deep as I'm thinking it could be, and it does rally again. So if you're sitting on the sidelines, well, you potentially miss that. If you're giving your stocks room to move and you can stay with, a portion of them, maybe a good portion of them, well, I think it's better staying in the game than preempting the worst, because the worst doesn't always happen. And look, as I said last week, I think as I've been saying for a while, I think it's a case of people wanting to buy the dip. They're the ones who need to be extra careful, especially for stocks trading below their moving averages. And we've got to really consider the downside risk when positioning our portfolios. And I think that's the way to play this market at the moment. So I think we've got to expect more volatility. It's going to be volatility on the upside and the downside. And it's being careful. Don't go in there trying to pick the low on this market. It's a vulnerable market, and it's a risky market. So let's jump over to the ASX 200 and see what's been going on over there. And I want to start with this one. This one I'm going to go to the hourly chart just to get us started. And my feeling is that, and pretty much like what I said with the S&P 500, my feeling is this market is going to try and rally over the next, I don't know, it could be the next day or two, it could be over the next week. Just looking at this, we had this aggressive sell-off on Thursday. We had all the news of Russia moving into Ukraine, all the war talk, and we had the aggressive sell-off. Interesting to see the sharp upward move during Thursday's session in the US, which was in the aftermarket in the ASX 200 on this chart, and we've had it. Markets pull back, but it hasn't pulled back to these previous lows. So it looks like that initial bout of bad news, of bearish news, is out there. The market's fallen, it's rallied back, and now it hasn't fallen back to these lows. That suggests to me that the immediate selling is done, and there is going to be an attempt to buy the dip. And I don't think this is a dip that we want to buy at this point, but nonetheless, I think there will be an attempt to buy the dip, which could push this market higher. So let's skip back to the daily chart, and I'm just going to draw in a couple of possibilities, just to sort of show you what sort of things which could happen here. So from where we are here, if we do get it, look, we could get a rally that doesn't come back too far. It may be just quite a muted bounce, as I spoke about at the beginning of this episode, and then we could have a crack down where it comes back and tests those lows from a few weeks back and breaks lower again, and we go into a larger pullback. And again, you look at the extent of this rally. If we did get a pullback like that, it's not that big a deal in the scheme of things. If it were to stop around there, something like that, that's only 15%. In the scheme of market movements, that's not a terribly big deal. That's one sort of possibility. We also could get a larger bounce. Could see the market sort of come back and break those highs. And actually, I might just do that again. It's we could see a larger bounce develop, and then we could be it could be some sort of we could see some sort of like a wedging pattern form. Like, these are all things to look out for. They're possibilities, not predictions. Like, say we've got a wedging pattern like that form over the next few weeks, then the market starts to lose momentum and give way, and we get the down move from there for another leg. All sorts of ways this could map out, but the possibilities which I'm favouring, which I think are the most likely, are the bearish ones at this point. I'm less likely for this market, in my opinion, for it to be quickly moving back up to new all-time highs. No doubt in my mind that is going to happen, but I don't think it's going to happen in the near term. I think this market has, and the developed markets in general, they've got more consolidation, more correction in them before we see higher levels. Maybe later in the year, I don't know. It's too far ahead of ourselves at this point to be making that sort of call. And look, the thing is, this part of the market cycle, it's the least enjoyable for almost most people. And some people love this part of the market cycle. They like being bearish. But for most people, this is the least enjoyable part. But it's what we sign up for when we get involved in the stock market. This is part of the cycle. It's unavoidable. You can't get out of it. It's unless you don't play the stock market. It's look. I think it's the uncertainty which is the hardest part of these parts of the market cycle, and that's when the trends are less clear. They're volatile. Bear market rallies can be deceptive and suck people in, and then you've got the despair of the down moves. It's the uncertainty really knocks people around, and that's why I think a trading plan and having good processes about knowing when to buy and when to sell, and how to manage your portfolio, how to spread your risk. I think that's why these things are just so important, because it's like the thing is you design your trading plan when conditions are calm and you've got plenty of time for clear thinking, and then you apply your trading plan, you follow your trading plan, your trading process when all this stuff starts to happen and it really gets uncertain, it gets hard, and you don't know what to do. It's that's the case for most people. They don't know what to do. They're going, will I hold a bit longer? What will I do? But if you've got that clear trading plan, you know what you're going to do. You're going to execute your plan and do what you decided to do, what you planned to do when the markets were calm and you could think it out nice and clearly. So that's how I'm handling this period, and I think that's the way to play it over the medium to longer term, to come out ahead, to see the corrections off, and to come out well over time. Follow your plan, and don't be too rattled out when these events happen. And look, let's move on from equities. Let's have a look at something else, something which is going up, which has been quite interesting to watch, and that would be gold. So gold's been very interesting over the last 24 hours has been very interesting in itself. I'm going to start with I want to look at this price bar here, but to do that, it's best done on an hourly chart. So let's just jump over to that just for a moment. This was all during the last 24 hours. We had this move in gold. It went from around 1900 to around 1,970 thereabouts. And so look, that's a $70 move. We had a $70 move very quickly, and a lot of, I think there's this fear of missing out sort of tied up in this. There's talk of war, there's tanks, there's stuff going on. Knee-jerk reaction is there's shooting, you buy gold, and you've got this quick rapid move up, and then it's all just settled down, and you've got a quick decline. It's just, gold's one of those markets I just hate to chase. I don't like chasing it, fear of missing out, because quite often you do get the snapbacks, which is very much what's happened here. So let's go back to the daily and try and put together what could be going on here. So okay, so we've had this breakout, and the breakout's continued to build on its momentum into that high last night. Put some Fibonacci's on it, on this move to date, and this is what I think could play out over the next few weeks. We've got the moving averages turning higher, but we've got a bit of overshoot here. The gold price has moved quite quickly above the moving averages, and we had that sort of like blow off move overnight. So quite possible we're going to see some sort of also a return move back to this breakout point. So we could see gold sort of like meander around for a couple of weeks, come back towards the breakout point, come back towards those the mid-range of the fibs, then maybe it starts to gain some more momentum. So I don't think there's a hurry to rush out and buy gold today. I think it's a case of right here. I think the play is to just wait and see what it does just over these next little bit of time. See if we do get this pullback. See how that develops. See if we do pull back a little bit towards the moving averages. Let the moving averages catch up to the price. And if this move is on, if this really is a legit breakout and the move higher in gold is on, I think this is a sort of move which could last for a couple of years, not just a couple of weeks. I don't think it's a case of having to charge out there and buy it today. And Let's just quickly jump to a weekly chart I want to just show you how it shapes up on the weekly. Like, you look at this on a weekly chart, and as I say, like, these moves in gold, when they get going, they can last for quite a long time. So if this move here is just getting started, there could be quite a lot in it, and there could be quite a long time that it runs for. Now, I just want to show you a couple of things while we have it. Like, it's possible. So just look at this. We've had the big move up, and then we've had the sideways range. We've just been in this triangle pattern. We're breaking out of it now. Similar sort of thing occurred here. We had the big move up, and you can see it. You can just see it in here. You got the triangle type consolidation in there. So just see what happened when gold broke out. Just try and get the scale a little bit better. Yeah, look, so gold broke out. It had a run, and then it had a pullback, and then it sort of chopped around and went sideways for a bit, and then it really started to get going. So as I say, the first breakout, a lot of people get excited, they charge in. Doesn't mean it's going to go shoot to the moon in the first week. Often it takes time for the mood to develop. That was the case here. That was February, and it didn't really get exciting until September. So really, as I say, if this is a move which could last for a couple of years, it's probably not all going to happen this week. Or next week for that matter. It could take a while for it to do something like this, go sideways and then round up. Another possibility, which it's always got to have an alternate scenario in mind. What could go wrong? What could we be missing? What else could gold do? Look at this period here. Like, we had the sideways move. It looked like we're getting the break out, the break higher, and it looked like the big trend was going to continue. Then it stalled, and we got a big decline. So that's not my favored scenario, but it's sort of one which I'm always aware of. Like, is this... The thing with this is this move's been on the basis of war talk and tanks and shooting. It's very much news related. I prefer it when a market breaks out. No one really knows why it's breaking out, and it kind of becomes obvious later. This one has been very much catalyst driven, which the concern with that is it's sort of like it's you buy the news, and then everything settles down, and you get a washout as the people who bought the news get washed out as the market does, shakes them out, does something else. And so there's always still that possibility that we get another move down, and that's where you get your that's where you get your classic zigzags. Then you could see that as a classic zigzag move down, and then from there we get the big move up. It's not my favoured scenario. I would go with the break. At the moment, I would go with the break, but I'd have that in mind. If the break starts to fail and we start to fall back down, I'd be going, well, maybe that's what we're looking at. So it's just a reason to always be cautious with the market. Don't think, oh, well, this is the time gold's going to double again. I've got to get everything in gold stock. I've got gold stocks. I've got to be in everything today. I've just got to pay the high. I've got to be in because this is off. It may not be off. There are other possibilities which could happen. There are other paths gold could take to go a lot higher, which don't involve going up today. Could be going up, but could be going up via a trip down here. So you've got to be aware. Got to be aware of how things could play out. And when I look at these local gold stocks, I'm going to look at let's look at evolution, and they're all pretty similar. The Australian gold stocks and also a lot of the global stocks. Looked at stocks like Newmont and Barrick. They're a bit different. Their moving averages have turned higher. But then you've got other stocks like in the some of the other larger North American stocks and also the Australian stocks. These moving averages haven't crossed yet. Getting pretty close. They are getting close now, so they could be getting near that time where these stocks are going to start to have a run. But the thing with moving averages crossing, again, it doesn't mean it's like the starting gun and the stock's going to be off and away. When the moving averages first cross, you often get the market does sort of pull back, do some work around the moving average, and then start to move higher. Doesn't always. It can just shoot straight up. Like, look, just here. But this was during the COVID period. It was a bit of a crazy period. It did shoot straight up. More often, I tend to find does something like that. So that's why I say I don't think there's a rush to get out there today and buy all your gold stocks. That said, my motion trader service signaled a couple of smaller stocks this week where the moving averages have turned higher and there is momentum in the share price. So it's very much a case-by-case basis, but let's wait and see. And if you're interested in the sort of like algorithmic scans that I'm doing to identify these entry points when the moving averages cross and when buying criteria is made, maybe just come across to the website and have a look at the 2-week trial which I offer for the service. And if you're just interested to learn more about the process, maybe just come over and go through the 4-part training series I have, which talks about entries and exits and trading with trends and that sort of thing. You can find that at my website, motiontrader.com.au. And by the way, if you're getting some value from this, please hit that like button and maybe leave a short comment. Just, hey Jason, like the videos, or just saying really simple. It just tells YouTube that people are watching, people are engaging with the material. YouTube shows more people and I make more videos. So that would really help if you could please do that. Quick comment and a click of that like button. And okay, so let's just wrap up with one more quick thing for the day. Very brief look at uranium, because interesting developments through the week, and really just in the last night or two, really just seeing this little this move higher. So it's interesting because we've had uranium sitting around this support band for it's a while now. This support, let's see, September, really going sideways for quite a few months now. And when we put the Fibonacci's on, we'll use this low for the fibs. The market has, it's come right back to around this 61.8%. We've got the support there, and now we're starting to see this this move higher. So look, it's got to do a bit more work before we get too excited, but it's a positive development. Better seeing it do that than start to edge back lower towards this support. Next thing I'd like to see like a break above here. That'd be the next sign that things are going well. Then we look at these highs, and then we start, if we can get up to around here, then we start looking at the possibility that we've had a move up, we've had a sideways move, and now we're having another leg higher. So interesting times in uranium. Still too early to say we've got a breakout, but it's looking interesting. So if interesting things happen, well, maybe we talk about that next week, maybe have a look at a few stocks. Let's see what happens. Okay, let's call that a wrap for this week. It's been a volatile time, but look, I think stick to your process and try not to get emotional about this. You know what you're going to do. You know where your exits are. If you're trading with good processes, I think stick to that. I think that's the best way to manage these unavoidably unpleasant times. So thanks for joining in, thanks for tuning in, and I look forward to coming back, talk to you next week. Okay, bye for now.